give me a yell, give me a call. Now, buying your first property, just to give you a thought, to every complex issue, there is always going to be an enticingly simple answer, and it will be wrong. Because you can make things simple, or it looks simple, but it is not the case, and I will validate to you why that is the case in the next 60 slides. So the adventure is beginning. Where do you start? Now, I understand that the time span of someone's in going to a webinar, at least for me, is 20 minutes. That's it. After 20 minutes, my mind wanders off. So if you forget everything that I say today, what do? Get yourself a pre-approval from a lender. What is a pre-approval? It is a letter from a lender saying that, yes, we can lend you 800,000 subject to property valuation only, or we can lend you 900,000 subject to property valuation from the lending institution that you intend to go to. And why should you be getting a pre-approval? One, it is mandatory if you are going to an auction. Because if you are going to an auction, you put down your 5 or 10% deposit and you're the successful bidder. For any reasons, you subsequently find that you're unable to secure finance, you will lose your 5 or 10% deposit. That's clear card. Not having pre-approval can also delay the lending process. A pre-approval is usually free and it is not legally binding. What does that mean? It means that I could go to Suncorp to get a pre-approval, but for any reasons, when I found a property, I elect to use the Commonwealth Bank, that's fine. There's no obligation to engage Suncorp. In other words, there's no obligation to engage the lender you got a pre-approval with. Just keep this in mind, 1/3 of over 90% lending ratio loans are automatically declined by credit scorecards. So you see a lot of advertisement going around saying that, yes, we can lend you 95%, but usually once you borrow more than 90%, a lender can decline a loan for any reasons. So especially for if you are borrowing more than 90%, do yourself a favor and get a pre-approval, which is free and not legally binding. So what should you need to do first before you even get a pre-approval? Get yourself a copy of your credit report. Again, this is free. Because if there are erroneous information in your credit report, for example, the credit report states that at some stage in your life, over the last 5 or 7 years, you haven't been paying your credit card bills on time, or you have overdue fees, or you have overdue fees, it could take 1 to 2 months to sort out the issue. And nowadays, pretty much all lenders, the first thing they do when they assess an application is to obtain a copy of your credit report. Or there are times where you could be a director of a company, even though you are PAYG, that means working for someone. This can be very problematic, especially if you haven't lodged your tax returns. In the past, we could get away with, telling the lender that the client is willing to write a stack back saying that the company is dormant and have no contingent liabilities. But nowadays, a lot of lenders, or in fact, most lenders, even if the company is dormant, they would need financials, and it could take a month to draft that out. So the steps are, get yourself a credit report at no cost. I've given you the website here, which is www.creditfile.com.au. Under the Privacy Act, Equifax, which owns this website, is obligated to give you a copy of your credit report at no cost. And once you get it, get yourself a pre-approval. So there's 2 steps to it. This is the most important thing, being a first home buyer, of what you should be preparing for. So for pre-approval, what do lenders usually ask for? What do lenders usually ask for? You need a copy of your credit report if you wish to engage us. 100 points of identifications. So a passport and driver's license will suffice. If you don't have a passport, especially a lot of passports lately have expired, given that we can't travel overseas, you can use your Australian citizenship certificate or your birth certificate in lieu as a passport to prove 100 points of identification. Evidence of income, usually by supplying the last two pay slips as well as the last year income statements. It used to be known as PAYG summary, which you get on the second or third week from your employer every new financial year will suffice. Now you may ask, as a rough rule of thumb, how much can I borrow? As an indication and an indication only. If your taxable income is less than 100,000, every dollar you earned, you multiply by 5 times. So if my taxable income is 80,000, I should be able to borrow about 400,000. If your taxable income is more than 100,000, you multiply by 6 times. So if my taxable income is 100,000, for example, I should be able to borrow 600,000. This is just as a guide. If you're self-employed, it can get a little bit more complicated, whereby if you're self-employed running a company, you do have to supply your last 2 years of individual tax returns, last 2 years of company tax returns, and notice of assessment. Why is so much needed? The reason is because for the self-employed, your income could fluctuate a lot. For example, last year, you could be earning 200,000, but this year you could be earning 100,000. With a lot of lenders either average up your last 2 years of income or take the average of the two. Or there's another circumstances where you could be earning 200,000 because you pay yourself 200,000, but your company could be losing 500,000 in profits. It could be making $500,000 in losses. So your net income is actually negative 300,000, which is why when you run a company, all lenders without exception will need both your individual and company tax returns. Evidence of deposit. Now, what do you need to supply here? You need to supply, depending on the lender you go to, bank account statements where salaries are deposited over the last 3 months. So some lenders need them, some lenders don't, but best to provide them so that it helps us to widen your lending options. Because often the clients, want something simple, but something simple lender may not be the lender that provides a good rate. So we ask everything up front so that we can widen your lending options. Credit cards, car finances, personal loan, HECS, and help debt will reduce your borrowing power. So obviously lenders would ask for statements along the lines to confirm your credit cards, car finances, personal loan, and HECS or help debt. Just to give you an indication, with credit cards, all lenders without exception look at your credit card limit, not the credit card balance, when determining how much they can lend you. As an indication, every $10,000 of credit card limit will reduce your borrowing power by at least 50,000, regardless of which lender you go to. So you can claim that you have zero card balances every month when you have a $10,000 credit card limit. That will still reduce your borrowing power. Car finances, personal loan, and HECS or help debt, how does that affect you? As a rule of thumb, every $1,000 of repayment will reduce your borrowing power by up to 120,000. So most lenders, they don't go by how much you still owe. They go by what is your monthly repayment on these commitments. There's exceptions to everything. I think ANZ calculate things in a slightly different manner, but most other lenders, they look at how much you're paying each month and how much that will reduce your borrowing power by. So canceling your HECS, car finances, or personal loans, that before applying for a loan will assist in increasing your borrowing power quite substantially, especially for first home buyer, because if you're paying $800, for example, for a car loan, that will reduce your borrowing power by approximately 100,000. So we see that over the years, the trend is lenders are asking for more and more information, and our offers users an app called bankstatements.com.au to help clients in shortening the time to retrieve paperwork. So how much you can borrow varies from lender to lender, and it is based on your income, your financial commitments, which I've just mentioned, whether you're paying principal or interest only. If you elect not to pay principal because, when you first buy a property, there is quite a lot of things. You have to find money to relocate. You may have to renovate for the first 6 months. You can elect to pay interest only. That is fine. But there are ramifications. All lenders charge a premium in interest rate for interest only loans. And also that will also goes towards reducing your borrowing power. So assuming you take up 5 years of interest only repayment, the rationale is lenders deem that you only have 25 years left to make principal reduction rather than 30 years, which is why even the interest-only repayment loan, the repayment is lower, it reduces your borrowing power. Number of child. As a rule of thumb, every kid that you have, you reduce your ability to borrow by 30 to 40,000. That is the base. If you are sending your kids to childcare or private schools, that will reduce your borrowing power substantially. So if, for example, if you are sending your 8-year-old kid to Sydney Grammar, which costs $30,000 a month, I beg your pardon, a year, that will reduce your borrowing power by up to $500,000. That is not wrong, all right? So if you send your kids the childcare fees or the private school fees is $30,000 a year, as a guide that reduces your borrowing power by up to $500,000. Does that make sense? It doesn't. But all this come under lender's obligation to adhere to responsible lending obligation, the owners of responsible lending. Now, the government is doing something about it on responsible lending. They think that this has gone too far because if you go by this theory, someone on $1 million household salary could be earning less than someone on $500,000, could be borrowing less than someone on 300,000, which is why the federal government is going to make amendment to responsible lending next March. It hasn't been, as we don't know whether it's going to pass through the Senate or not. At this point in time, just keep that in mind. Living expenses reduces your ability to borrow substantially. What do I mean by living expenses? 2/3 of lenders will reconcile your credit card and transaction statements against your declared living expenses. Say you have a couple on 250,000 with no kids. Minimum living expenses is usually defaulted to around $5,000 a month. For every $1,000 you spend beyond that, that reduces your ability to borrow by about 120,000. So which means that if someone is you in theory you use an online calculator, you may pass the borrowing powers test because it doesn't factor in. It just uses a default living expenses of 5,000 a month. But if you're spending 12,000 a month, that could reduce your ability to borrow substantially with 2/3 of lenders. Some other lenders, they don't reconcile your actual living expenses with the declared living expenses, but some lenders do. So keep that in mind. Living expenses is a big problem. That's what we find. I'm not in favor of responsible lending. As I said before, someone on $1 million spending $35,000 a month may only be able to borrow $500,000. Someone earning $80,000 with living expenses of $2,000 a month may be able to borrow about $500,000 as well. It doesn't make sense, but just keep in mind, in short, living expenses will affect your ability to borrow. Lender's mortgage insurance, what is that? In general, if you borrow more than 80% of the property value, your loan needs to be mortgage insured. Keep this in mind. Mortgage insurance is not to be confused with MPI, which is mortgage protection insurance. Mortgage insurance is there to insure the bank in the event that you default, not to insure you. but you will have to pay for it if you borrow more than 80% of the property value. There are about 400 lenders in the market, but there are effectively only 3 mortgage insurance companies that dominate the market. The biggest one is being Genworth, followed by QB and Arch Capital. Why is this important? For example, if you go to St. George to get a loan, and the loan is declined for any reasons, and you subsequently elect to use Bank of Melbourne, Bank of South Australia, RAMS, Westpac, who are also insured with Arch Capital, more than likely your loan is going to be declined because they hold the same database about you. So a lot of people think that this is a free market, there's 400 lenders to choose from. Not so if you're borrowing more than 80%, because often the loan is not declined by the bank, but rather the mortgage insurance company. So something to keep in mind, there are only 3 insurance companies in the market. If you have to borrow more than 80%, you also have to prove what is called genuine savings. So genuine savings policy kicks in at 80, 85, or 90%, depending on the lender you go to. So what is non-genuine savings to start off with? A lump sum gift from your parents, the tax returns rebate which you may have just got lately. If you're getting half yearly or annual bonuses, they cannot be deemed as genuine savings. And what is genuine savings? It means that if you buy a $1 million property, you have to validate 5% genuine savings, which means that you have held $50,000 over the last 3 months. You can say that I got a rebate, a tax return rebate of $50,000 today. I want to borrow 95% for $1 million property. You will feel the policy on genuine savings. And lump sum gift, tax returns rebate, bonuses, and the grants cannot be deemed as genuine savings because they are inconsistent or one-off. You may only get them this year. You may not be able to get them the next. So something to keep in mind, you need to prove 5% genuine savings for, which means that for $800,000 property in this case, you need to validate that there's $40,000 in the bank. If you're borrowing more than 80% of the property value, you also have to be careful of the type of properties you're buying. Now, this is unfortunately a risk that a pre-approval cannot help you mitigate. Just to give you a guide, for example, I just have a client who is using me right now. He bought a property at auction at Randwick for $1.07 million. He passed the borrowing powers test by a mile because he's on a very high income. He has got a pre-approval with St. George before, and subsequently, he can't get a loan with St. George because the property is unacceptable for lending purposes according to St. George. Because postcode 2031, which is Randwick, there's a lot of buildings there where St. George will not take up at all. So you don't have to be careful in general. If you buy a property in the city, Chippendale, Zetland, Walleye Creek, Parramatta, Rhodes, there's a lot of lenders that will only lend up to 70% or 80% for it, irregardless of your income. Why is this the case? Because the lender deemed that there's too many apartments being built in this area. And when there's many apartments being built, it doesn't mean that prices will go down, but prices tend to be volatile and fluctuate. If prices goes up, the lenders do not benefit. But if prices goes down, and statistically 1 out of 160 people can't afford to repay the loan, the risk to the lender is greater, which is why they have blanket policy, especially Zetland and Parramatta of late. Most lenders will not lend more than 80% or even 70% for it. If you go to Commonwealth Bank, for example, the biggest lender in the market, if you buy a property in Zetland, you have to start to pay lender's mortgage insurance at 70% and above, not 80%. They just introduced this policy about 4 months ago. And the same if you buy in Parramatta or Walleye Creek. So keep that in mind. Be very careful if you're looking at buying an apartment in this postcode, most lenders have some form of restriction for them. And a lot of people get caught out. I see that again and again because they got a pre-approval, but unfortunately, pre-approval does not mitigate valuation risk or the property being deemed as unacceptable for lending purposes. Anything more than 5-story high or with more than 50 units in the block. If you go to a smaller lender, for example, a credit union or money manager, you'll find that most lenders, most of them will only lend up to 80%, regardless of where you buy the property. Why something more than 5-story high, they don't like that? Because if you, as the mortgagor, can't afford to repay the mortgage, the lenders is going to help you pay for your strata fees until they foreclose on the property. And anything more than 5-story high or more than 50 units in the developments, they come with amenities like a lift. A lift is an amenity, a swimming pool, a tennis court. It all costs money, which pushes up strata fees, which is why smaller lenders, a lot of smaller lenders, especially credit unions, once you buy a property more than 5-story high or more than 50 units in the development, they don't lend. Usually the bigger lenders are fine because they can spread out their risk better, but you have to be wary of the smaller lender. They do not like apartments too much. Studio, bachelor, and one-bedroom apartments, there could be restrictions, especially if you go under 50 square meters of living space. When I talk about living space, it means that you cannot take the car park and the balcony as living area, only the internal area. Anything less than 50 square meters, you have to be wary. Anything more than less than 40 square meters, you'll find that no lenders in the market will lend more than 80% for it. Company title properties, they usually sell at a discount, with comparable strata title properties. You'll find a lot of them in Surrey Hills, Darlinghurst, the King's Cross area, and even in the city. With company title, you're actually buying into a company that owns the property. You're not buying into the property directly. There's certain advantages in setting it up that way. I won't discuss too much about it. But the reality is, if you attract a much lesser interested party, if you default on the mortgage and the lender have to sell the property, which is why most lenders may only lend 70 or 80% for it. I think the best lender for this sort of loan probably is St. George. At this point in time, they can still lend 85%. But some lenders, for example, if you go to ING, for example, they may not even lend for company title property or Macquarie Bank. Buying brand new and off the plan. A lot of incentive are given to first home buyers for buying brand new and off the plans at this point in time, which I will discuss in subsequent slides. But you do have to be careful of what is called valuation shortfall. Again, this is not something that can be mitigated by a pre-approval. What is a valuation shortfall? For example, you want to borrow 95% for 1 million purchase. You're on $300,000 income. You pass the borrowing power test by a mile. That's fine. But keep that in mind. Lenders lend you money not based on the purchase price, but the lower of their purchase price or their valuation. If you buy a property at $1 million, valuation comes in at $900,000. Lenders will only lend you 95% for $1 million property. I beg your pardon, 95% for 900,000 valuation, not 95% on 1 million. And subsequently, you will be short of funds to complete on the purchase. The newer the property is, the greater the chances of valuation shortfall. The reason is very simple, because new improvements depreciates more. Properties in unlivable conditions. I have clients wanting to buy in Glebe, for example, wanting to buy a terrace in New Tower M which is in a very run-down, unlivable conditions. Lenders may not even lend a cent for it. Why? Because they deem that you not only have to buy the property, but also to spend $50,000, $100,000 to put it into a livable condition. And as such, that will put undue burden on financial burden on you, and as such they don't lend. So be wary of this if you are looking at buying something of value, for 1.2, 1.3 in GLEAD, for example. Some lenders may not lend at all if you have to borrow 95%. And the issue here is what is unlivable to one lender may not be unlivable to another lender. I recently have an issue where the client was buying in Surrey Hills, and the loan was declined by Bank West because they deemed that it's unlivable. But when we send it to another lender, they have no issue with it. So if you come across such a situation, don't bother arguing with the bank. You will never beat the value of words. Just move on to a different lender, which may be able to engage a different valuer and have no problem with it. Do not argue because it's just a waste of time. The appeal success rate, from what I can see, is around 2 to 3%. And often it is actually more to do with they valuing the wrong address rather than the valuation report being a problem. So all this here are unacceptable to a lot of lenders if you have to borrow more than 80%. But if you're buying a service apartment, retirement village, or student accommodations, forget it. You will not get. You need usually at least 50% deposit. Why? Because for service apartments, retirement villages, and student accommodation, if you're buying it for investment as your first property, the yield, that means the rental returns on them may be high until recently because of COVID-19. You could be getting 7 or 8% in rental returns. The problem is the strata fees for this sort of property is also very, very high because there's always going to be a manager in there full time. And as aforementioned, the technicality is if you can't afford to repay the mortgage, the lenders by law is obligated to help you pay for your strata fees, which could easily amount to $10,000 for 500,000, say, student accommodation a quarter. And lenders is not going to lend you 95% to buy such a property because they are out of the money in the first place. So something to be wary of. Just because you get a pre-approval doesn't mean that you've got a loan. It is also subject to the type of properties you're buying. If you're buying a house, lenders like it more. If you're buying an apartment, be wary. Now, I move on to the next slide on mortgage insurance. How much mortgage insurance costs? This is a guide back to 2019, which was last year, of Westpac mortgage insurance charge. If you have to borrow up to 750,000, which is where most first-home buyers in my office will borrow for their first property. At 85% lend, you can see that mortgage insurance is at 1.24% of the loan amount. It's always going to be based on the loan amount. 90% it rises to 2.41, and 95% it rises to as high as 4% of the loan amount. Mortgage insurance can vary by more than 30% for loans, especially if you're borrowing 90% or more. Which is why if you're after value or something cheap, don't just look at the interest rate. Also look at how much mortgage insurance is going to you're going to be charged on mortgage insurance because it can vary by more than 30%. Just to give you a comparison, a 0.1% difference in interest rate for $500,000 loan only equates to $30 a month or $360 a year. If you have to borrow 95% for a $1 million property, mortgage insurance charges could differ by more than $10,000, depending on the lender you go to. Some lenders may waive mortgage insurance for medical, legal, engineering, and accounting professionals, not because they earn a lot, but they are deemed as, for example, a medical professional is deemed as recession-proof. Whether I have money or not, I can use my Medicare card or PBS to go and visit a doctor. For accounting and legal professionals, some lenders like them because, let's just say you practice as a partner for an accounting firm. You want to pay off your mortgage because if you lose your license and you're sued into bankruptcy, you can't practice as a partner of a certified or chartered accountant, and the same applies to the legal field, which is why certain lenders like them are happy to lend up to 90% without mortgage insurance for them. Only major lenders will lend more than 90% for more than a $1 million mortgage. Let's just say you want to buy, you're on a high income, you want to buy a 1.5 million property, and you need to borrow 95%. I can tell you right now, amongst the major lenders, only two lenders can do it, Combank and NAB. No other lenders in the appetite has the appetite to lend 95%, especially when you buy a property more than $1.2 million. So something to keep in mind about mortgage insurance. So this is just to give you a guide. As I said to you before, a 0.1% difference in interest rate only equates to $30 a month. Mortgage insurance, you always have to check the charges to it. And every lender has a different mortgage insurance charge, even though they use one of three mortgage insurance company in the market. And also, I understand that rate is important, but it's not everything, because the cheaper lender in the market today may not be the cheaper lender in the market tomorrow. And this occurs a lot with smaller lenders. The reason is because their rates are not as heavily scrutinized than your Westpac and Commonwealth Bank. If Westpac and Commonwealth Bank increase their rates by 0.05% tomorrow, they will be on the papers. But if you go to XYZ or even my home loan, mortgage rights home loan, if you can increase the rates by 1%, it's not even going to hit, a section of the tabloid on the last page. So as a rule of thumb, I do think, I can substantiate this, bigger lenders, the risk will remain stable, more stable than smaller ones. Paying mortgage insurance must be weighted against rental payment. So if you have to borrow 95%, most mortgage insurance costs you between 3 to 4%, you have to evaluate, is this the right time to buy? Because by paying the 3 or 4% in mortgage insurance, that equates to about 6 months to 1 year of your rent that you may be currently paying. I think a good guide would be, ideally, if I was doing this myself, again, I would consider borrowing up to 90%, which is 88% base amount plus mortgage insurance. I wouldn't try to cross the 90% threshold, because once I cross it, mortgage insurance rate increases substantially, and also rates increases substantially. Now, most lenders won't tell you that just because you're borrowing 95%, the rates cost more. The reason is because today, assuming you go to the biggest lender in the market, Commonwealth Bank, their reference rate is at 4.55%. Everyone gets some form of discount, no matter your circumstances. But if you borrow 95%, significantly less discount are provided to you. So technically, it's not more expensive, just that you get less discount, which means that it is more expensive. So something to keep in mind, and which is where the bigger lenders, the smaller lenders do have an advantage here. In general, if you go to a credit union, they charge the same rate whether you're borrowing 70, 80, or 95%. But if you go to a bank, in general, if you can come up with, they give out their best rate to people with significant deposit. For example, if you go to St. George or Macquarie Bank today, the best rate are given to people with more than 40% deposits. That means you're not borrowing more than 60% of the property value. Because in this current climate, not a lot of lenders have the appetite to take on high risk loans. So it is fair to say that there's a lot of lenders, you may be hit left, right, center about 95, 98% lends, but the reality is it is going to be significantly more expensive. So steps involved in getting a home loan. Get yourself a pre-approval. It could take between 1 to 20 working days. That means a month. That is not a typo. Why? Because pre-approvals is not deemed as priority. To the lender, 2 out of pre-approvals does not lead to a sale. So they're doing up the pre-approval for nothing, which is why it's always treated as of last priority. So it can take between 1 to 20 days. After you got a pre-approval, you find yourself a property. And then if you're happy with the property, you like it, you want to buy, the seller is selling the property to you, you put down a 0.25% deposit, which once the seller is selling the property to you, subject to him or her counter signing. What do I mean by that? A lot of first-home buyers will fall into the trap thinking, yep, I put out my 0.25% deposit, which is only $2,500 for $1 million property. I buy the seller to sell the property to me. That is correct only if the seller countersign. Often the seller will find all type of delays and excuses in not countersigning, and then 2 weeks later, he finds someone that's willing to pay a higher price than you. And then there you go. You get back your $2,500 deposit, but you've lost the property. So don't be the backup of a backup of a backup of the seller. All right. If you put down a deposit, ensure that you give a time frame to the seller to countersign on the contract immediately, if not immediately in the next few days. Otherwise, you will just be a backup buyer for the seller or the real estate agent. Once you put down a deposit, you have finalized on the purchase price, valuation will be conducted. How long does it take to do a valuation? Between 1 hour to 5 days. Why? If a property is deemed as low risk, the lenders, when they do their valuation, will not physically inspect the property, and that will be really, really quick. You get a valuation back within an hour. But if the property is deemed as high risk, you have to borrow 95%. A physical inspection needs to be done. If there's a tenant in that place, he may not allow the valuer to enter the premises within the next 5 days, and this could delay the valuation process. Once the valuation comes back, you put out your 10% deposit. This is where the purchase becomes legally binding, and between exchanging contract and settlement, by default, you have 6 weeks. Settlement is the day you get the keys to the house. So what do lenders look for? We call this the 4 C's of lending. Key is, and the most important is, how much do you earn and spend, the capacity. Keep in mind, if you're a contractor or temp, as a guide, your income is calculated over the last 46 weeks, not 52 weeks. The reason is because as a temp or a contractor, you may not be getting sick leave, you may not be getting annual leave, may not be getting personal leave. So your income is in general calculated over 46 weeks. And as a rule of thumb, you need to have work, especially if you're temping, for the same employer over the last 6 months. This is the proof income stability. All right. You can say that I'm on a $300,000 roll, being paid $3,000 a day, but I just started as a temp for 1 month. You'll find that most lenders in the market, with the exception of 1 or 2, will not lend the money to you. Overtime pay and allowances that are paid consistently over the last 12 months can be considered. The key word here is consistent. You can't say that I'm getting this overtime pay this month, not the next month I'm getting it again, and then not the previous month. Along those, it has to be consistent. Bonuses cannot be considered unless it is paid on a consistent basis, and by that it means that you must have received bonuses for the last 2 financial years. As above mentioned, income for the self-employed is based on the last 2 years. And discretionary expenses. This is where we often get caught out. Client is on a good income, and subsequently we find out that 2 kids are in private schools and it costs $50,000. That just clear off the borrowing power. Especially if your kids are in private schools and you spend a lot of money in traveling, that will affect your borrowing power. Do let us know beforehand. How good we are is contingent on the information you feed us, which is why whenever we have a new client, we send out 30 questions to the client, and often clients will go, oh my God, just to speak to Raymond, I need to answer 30 questions, because if we don't ask those questions, we cannot help you mitigate risk, and this is our job to help you mitigate risk. Credit history. Please go get yourself a free copy of your credit report. Why? Because you'll be quite shocked. About 10% of credit reports has erroneous information in there. All right, you could be known as Paul Smith. Paul Smith number 2, his information is in your file, and Paul Smith number 2 has 5 credit defaults plus 6 overdue charges, has not been paying his utility bills. That could be in your credit report. So please do yourself a favor, get it, and it is at no cost. Character: permanent employees must pass probation. Contractors with some lenders must prove that you have held the income for at least the last 12 months. Some lenders, they say that you have to be with the same employer or the same company you render services for the last 6 months. Credit cards or personal loan, ensure they are not over the limit and they have no overdue fees. Because in theory, the lenders can report you to mycreditfile.com.au once you're more than 14 days late. It's not a lot of time, 2 weeks. Usually, they give you you have to be late for 1 month before they put it in, but technically they can. Once you're more than 14 days late, that is considered overdue, and that will clear off your credit scores. So next time you go and get a personal loan, if you have a low credit score, you won't get the best rates, because personal loans nowadays, let's just say you get a car loan, the interest rate difference between you going to Latitude Finance, for example, to get a personal loan, your score is 900 points. You probably get a rate at 6.99 and 7.99%. But if your score is 540, the rate could be about 21% for the same loan. Another day, they won't lend. So something to keep in mind, it is best to have a high credit scores. It could affect many things you do, not just your home loan down the track. Keep in mind that lenders prefer old over new properties, because it's similar to you buying a brand new car. New apartments with new improvements depreciates more, especially when there's no land value or very little land value. Lenders prefer older type properties over newer type. An older type property, that's the probability of a valuation shortfall is less. A new property, the probability of a valuation shortfall could be up to 40 or 50% in certain suburbs. If you tell me of late in Parramatta, I can tell you that pretty much all brand new properties, the valuation is going to come back short. Lenders prefer houses over apartments. Be wary of this if you're borrowing more than 80%. And why do they prefer houses? There's no strata fees. And houses comes with land value. So you could buy a really rundown place in Mossman. The rundown house may be worth 200,000, but the land could be worth $5 million, and it doesn't depreciate and may in fact appreciate. But if you buy an apartment, you're sharing it with 50 other occupants in the building, or 200 other occupants in the buildings, and lenders don't like it. It doesn't really matter if you're borrowing, say, 60% of the property value, what type of security you're buying. But if you're borrowing more than 80%, you have to be aware of that apartments, a lot of lenders have restrictions in certain areas sought after by first home buyers. For example, Zetland. Purchase price. Now, don't underestimate. I would say that 2/3 of first home buyers underestimate the deposit required. And that is because of people like us. All right. My mortgage firm, we have advertisers, our marketing team always say that you can borrow 95 and 98%. I personally, I think that is highly misleading. Because just because I say that you can borrow 95%, it doesn't mean that you just need 5% deposit. You need 5% deposit plus, in most cases, stamp duty, mortgage insurance, legal costs, and land titles office charges. So this is just to show you how that works. Let's just say you buy a $600,000 established property. The government will waive your stamp duty. So there's no stamp duty, that's fine. Legal costs, of which you can find yourself a conveyancer and or a solicitor, whereby a solicitor can provide legal advice and property advice. It's going to cost you $2,000. But mortgage insurance is going to cost you $20,000, and you have to pay for that. So, the cost itself is about $22,000. So if you come up with 5% deposit, that's 30,000 plus your cost. Primarily, that's to do with mortgage insurance. Even at 95% land, you still need to come up with $52,000 of your own funds, not 30,000 because of cost. So I repeat, when lenders say that they can lend you 95%, it does not mean that you only need 5% deposit. You need 5% deposit plus stamp duty and mortgage insurance. And this is just for 600,000 property where your stamp duty is already waived. Imagine if you buy an 800,000 property, even at borrowing 95%, you have to come out with 106,000 if you buy established, because mortgage stamp duty is not waived. Once you buy a property more than 800,000 for a second-hand property, plus mortgage insurance, they add up to about $66,000. So even at borrowing 95% of the property value, you need to contribute 106,000, which is a lot of money. So remember this, it's all our fault. Maybe not. It's my marketing team and other brokers and banks marketing team that come up with certain crap that give people the illusion that you only need 5% deposit, which is very, very wrong. So let's just say you can't come out with the deposit, which you need at least 105,000 for even an 800,000 humble, two-bedder apartments in the inner city area. What can you do? Family guarantors. If you're a parent, you can in theory borrow up to 100% of the property to be purchased. If your family is willing to, family member, usually a parent, is willing to pledge a property as security. How does this work? You buy a $500,000 property and you want to borrow 510,000. You can if you have a guarantor. Why? Because if your parents is willing to pledge a 500,000 unencumbered property as security, the lenders will deem that they have $1 million of collateral at hand, but you're just borrowing 510,000, and you're just borrowing 51% of the property value. And even though you're borrowing 101% of your property value, you don't have to pay mortgage insurance. And you can borrow up to 100% plus cost with some lenders. What are the cons? You restrict your parents from selling your property during the guarantee period. You can only discharge them once you have held 20% equity in your own property, which means that you have dropped the loan down to 400,000. And the guarantor runs the risk of losing their property or having to make repayments on the loan in the event of default. So you subject your parents to a lot of risk, but clearly it does have its own benefit. And why do I say a parents in this case? Because your boyfriend or your girlfriend or your siblings may say that they can help you. Until they know that, they have to help you repay the mortgage if you can't afford to repay it. And maybe that's the time they freak out. So that is something to keep in mind, family guarantee. So choose a product that's right for you. Every lender you go to, they have 20, 30 different products running around. But they can be classified into three major types. Basic loan, about 15-20% of people take them up. And a standard loan, about 60% of lenders will take them out, of borrowers will take them out. What is the difference between a basic and a standard variable? Most lenders in the market to start off with, they don't call it basic or standard because it doesn't sound sexy now. So if you go to ING, they call their basic variable a mortgage simplifier product, and they call their standard variable an orange product. So most of them have some form of marketing name for it. The key difference comes down to an offset facility. A standard loan comes with an offset facility, a basic loan doesn't. How does offset works? If you look through carefully in the link that we have sent you, I should have given you, or my colleagues have given you 2 or 3 links on how offset works. But to summarize it in 20 seconds, this is how it works. You have a $1 million loan, but you have $50,000 in your everyday account. On that day, if you have a standard loans with offset facility, interest will be calculated based on the net of the two, being 950,000. A standard loan comes with that, a basic doesn't. What are the rates? cost between 2.7 to 4.55%. Again, this is not a misprint. I will tell you why that is the case. Because lenders give out discount the interest rate based on your loan amount, whether your interest only or principal and interest, your lending ratio, whether the property is for own occupy or investment. So they have 20 different rates for the same type of product depending on your circumstances. So in Commonwealth Bank, they start from around 2.7 to 4.55%. For basic loan, at 2.69 to 4.59%. A fixed rate, you can fix for 1, 2, 3, 4, 5, up to 10 years. But the most commonly taken out fixed rate is a 2 years fixed rate, followed by 3 years, followed by 5 years. At this point in time, Commonwealth Bank fixed rate, if you are paying principal and interest, owner occupied, you're borrowing more than $1 million, probably you can get a rate of 2.14%. But assuming you're borrowing 100,000 investment interest only loan, the rate will be at 3.54%, and that is not negotiable. The rates can differ by about 1.4% depending on your circumstances. If you take up a fixed rate, keep that in mind. The fixed rate is a lot cheaper than a variable rate, but it does have limitation. Most lenders in the market, fixed rate, there's a cap on additional repayment. So you can't say I want to pay as much as I want, because they will cap that to not more than $5,000 to $10,000 of extra repayment a year. Whereas with a basic or standard loan, you can pay as much as you want to your heart's content. Most fixed rate in the market, or virtually all lenders fixed rate in the market, don't come with 100% offset facility. And most fixed rate in the market, there's no withdrawal facility, which means if you have paid $10,000 extra and you want to take this $10,000 out in 2023 to buy a car, you can't until the fixed rate term is over. So these three products alone constitute about 95% or if not more of the market. In the past, there is a facility called, a type of product called line of credit. But nowadays, a lot of lenders don't offer them because they are deemed as not in line with responsible lending. What is a line of credit? I just tell you very, very briefly because very few people take that out nowadays. You could take out a $1 million mortgage limit, but in the beginning, you may only need to use $800,000. Next month, there's no repayment at all if you don't want to, because interest is just put on top of the loan. The next month, there's no repayment at all again, because interest is put on top of the loan again until you hit the limit of 1 million. In the past, people take up this type of loan because they could be on dual income right now, but they expect to have a kid next year. There's only one income, and they can just capitalize on the loans interest until they hit the original mortgage limit. But in 2018, this was deemed as not being responsible lending by some people, and as such, very few lenders offer that nowadays. And the interest rate, if it's offered, is going to be a lot higher, from 4.33% to 6.03%. So you're expecting to pay a premium of 2 to 3% more over a standard basic or fixed rate loan. Basic variable, avoid unless your loan size is less than 250,000. Why? Because a lack of offset facility will reduce the tax benefit if you change your first home to investment use down the track. I'm not going to elaborate too much on this. The reason for that is because otherwise it gets too complicated and everyone is going to fall asleep. In fact, I think I just lost a guy listening to me going on and on about a mortgage. I will finish in the next half an hour. Take up a standard loan if you're borrowing more than 250,000 because you're utilizing, because an offset facility, I think that is really, really important to have one. A fixed rate loan provides the certainty of repayment, and this may be a good time to fix. Why do I say that? Because the Reserve Bank cash rate, that means the government cash rate, is already at 0.25%. So how much further can it go down? And at this point, the difference in interest rate between a fixed rate and a variable rate is around the 0.5% mark. Just keep in mind, a fixed rate has a cap on additional repayment, and virtually no lenders offer an offset feature for it. For bank, the only banks that I know for that offer offset on their fixed rate is Bank of Queensland and also Bank of Adelaide Bank. Line of credit is good for people on inconsistent income, someone like a self-employed, a couple planning to have a kid, or contractors. But now the interest rate premium that you pay is more than 2%, so I'm not quite sure whether it's still worthwhile doing that or not, which is why the take-up of line of credit products has dropped to about 1%. So it's your choice. You want to fix a variable, or you can even speed up the loan. If you're buying a place to live in, it is best to speed up your mortgage. So what does that mean? You take up an $800,000 mortgage. You could have 600,000 as a fixed rate. The rest is a variable component to make extra repayment and to have an offset account. In most cases, I would suggest if you want a fixed rate, don't take up a fixed rate in its entirety. Speed up the mortgage so that you at least have some benefit in offset. Features, does it come with internet banking, redraw, offset, free redraw, free ATMs, frequent flyer points, free credit cards, savings account, discount home and contents insurance, and so on. For different lenders, they add all this in depending on the type of products you take out. As aforementioned, check how much does your mortgage insurance cost if you're liable for it. Is there a way of waiving it? At this point in time, St. George can lend up to 85% for $1 of mortgage insurance. That is a very big advantage. So from time to time, lenders come up with these sort of policies. Previously, up to June, NAB has the same offer similar offer whereby it offers a 25% discount in mortgage insurance. And that is a lot, especially if you're borrowing 95%. Right now, that offer is over. It's St. George time to give out a special offer, 85% lend for all borrowers at $1 of mortgage insurance, up to a $1 million loan. Deposit required, do you need 5, 10, or 20% contribution? You need to prove genuine savings. Paperwork requirements, they differ a lot between lenders. For example, today, you apply for Suncorp loan. I will ask you for 3 months of transaction statements and credit card statements. They're very stringent on that. They will reconcile your declared living expenses with actual living expenses from your credit cards and savings account. But if you go to Macquarie Bank or ING, they don't ask for it. Additional repayments allowed. Is weekly repayment allowed? Why do I say is weekly repayment allowed? Assuming you take up a basic loan by paying weekly, you cut off some of the interest being paid from then paying monthly. Why? Because interest, regardless of which lender you go to, is charged on a daily basis, not charged on a monthly basis. So by killing off some of the principal that you owe on a weekly basis, you cut off some of the interest from being compounded. So this theory is also the same with your credit cards. If you look at all your credit card statements, by law, your credit card statements will tell you how much interest it is per day, not per month. How much is your home worth? Valuation is very important. Unfortunately, it is not a risk I can help you mitigate. But this is just to give you a guide of how lenders do their valuation. The simple, most important thing that lenders look at is comparable recent sales. How much your neighbor sell his or her property for? So unfortunately, if you're in, say, Penrith or Liverpool or Parramatta, there's a lot of properties for sale, which is why it's dragging down the prices of valuation. And also because in Parramatta, there's a lot of new apartments coming out into the market, arguably. It is best to own the worst house in the best suburb than to own the best house in the worst suburb if you're looking at capital gains. The reason is because improvements on your $1 million improvement will depreciate over time, but the land value does not depreciate. And when you think about how much to buy for a property, always balance up your emotions versus numbers. Because ultimately, you may be able to find someone that can assist you in getting a mortgage, but no one can help you make repayments. This year is a very good year to think about these rhetorical questions here. For example, a lot of pilots, they're now out of a job, when in the past they could be on $250,000 to $300,000 income. They're struggling, and there are a lot of unexpected things we thought would never happen in our lifetime. They have happened. What are your contingency plans in place? So something to keep in mind. Or if you're in the travel industry, you could be making $500,000 in the past as a very, very good travel consultant. But right now, you'll be lucky to be making 50,000. So these are things that I cannot help you plan. I can only alert you to that to complicate matters. If you need to know more, speak to me. I'm here. I'm on Facebook. I'm on LinkedIn. I'm on Mortgage Nights in Piedmont on Google. Send me an email. And then my website has a borrowing power calculator and a repayment calculator if you're not comfortable in speaking with me and my team. But I can guarantee you we don't bite. All right? We can give you good information. Please get yourself a credit report. It will help you. And if you need to know more about government grants, visit the Office of State Revenue. And talking about grants, what can a first home buyer get? This is where it gets complicated. I'm starting to lose it because there's 6 or 7 different, government incentives around. So I've been trying to summarize it as best as I could. First of all, a state grant. You get $10,000 for buying a brand new home up to 600,000, and then up to 750,000. If you're looking at building something, you get $10,000 in grant. To get an exemption from stamp duty, you differentiate between whether you're buying a brand new home or an established property. Concession on stamp duty on new homes is, I beg your pardon, sorry, let me rephrase this, all right? That's why I'm telling you I'm confused myself, yeah? If you buy a property up to 650,000 established, there's no stamp duty at all. If you buy a property brand new or off the plan up to 800,000, there's no stamp duty. So the threshold is different. If you buy an established property between 800,000 and up to 800,000, you get a concession in stamp duty. If you buy a brand new property, you get a concession in stamp duty up to $1 million. So something to keep in mind, the threshold for new and established property differs. Then you have a government grant, a federal government grant. This is for Australian citizens only. It does not apply to permanent residents. You can have up to 95% lent with mortgage insurance waived for up to a 950 new or off the plan purchases only. Until last week, you can buy up to 700,000 established property where you can borrow up to 95% with mortgage insurance waived. But it has changed since the budget come out. So FHLDS is only applicable for new purchase or off the plan purchases only as of this week. It no longer applies to the purchase of a second-hand property. So if you Google, you're going to get confused all over because they could still have information relating to FHLDS 1. FHLDS 2, which comes out only applied to brand new or off the plan. You could put $15,000 per year in voluntary contribution to super. $30,000 plus earning can then be withdrawn in the second year. There's a home builder grant. You get $25,000 for building a new home up to $750,000. Or if you're doing a heavy renovation, $150,000 renovating a property up to $1.5 million. So how much can you save in stamp duty? Stamp duty concession applies up to $1 million as aforementioned for the purchase of brand new property, 800,000 for the purchase of established property. So as a guide, at 800,000, if you purchase a brand new property, you save yourself a good 31,000. This is a lot of money. Why? Because if you think about you having to save up 30,000, you actually need to be earning 45,000 because you probably are taxed at 32.5 to 37%. All right, plus you get $10,000 in grant. That adds up to 40,000 of government benefits. Plus, you may not have to pay mortgage insurance. That potentially add up to $70,000 in grant, which actually equates to you having to earn 100,000, and all this within the space of the last 6 months. And that's why I admit this, I'm all confused myself. Every time someone calls me about what sort of benefit can I get, I actually look at the template that I've written beforehand. Because I'm too old to remember all of this, the threshold is at different price point. And what is the template I use? I show that to you very briefly while I have a drink. I have given that template to you as well. I'm going to show it to you right now. I wouldn't talk to a first home buyer without this because I can't remember myself. But I've created a template. I'm going to show it to you right now. I've given this to you as well, but you may be getting an old version of mine because the federal government's FHLD scheme has changed. So these are the 5 grants that I'm getting that you may potentially be getting if you're buying brand new. So we have given you a copy of these. Okay, I've turned that off. You can take a screenshot if you want. So I have 18 minutes left. There's still a few things to run. And here we go. So the first home buyer's loan deposit scheme, I repeated this, whereby you can borrow up to 95% without having to pay mortgage insurance. If you borrow 95% for a 900,000 property, for example, stamp duty can be up to $40,000. But right now, it is at no cost. Unfortunately, it is only for new or off-the-plan property only. If you are applying this as an individual, it's up to 120. You're only eligible if you're not earning more than 125,000, 200,000 for a couple. If you're permanent residents, forget it, because this is a federal government grant. It's only applicable for citizens only. If it's a state government grant as a permanent resident, you are entitled to it, but not for federal government grants. Then you have the federal home builder scheme. You get $25,000 in grant as aforementioned for property up to 750, or in renovating a property up to 101.5 million. Again, you have to be an Australian citizen, not earning more than 125,000. Purchasing off the plan. What are the benefits? You get a lot of grants, especially if you're buying something like 600,000 and 95% land. Potentially, you're getting $50,000 in grant. There's no stamp duty at all. It gives you time to save up for a deposit. And it may even give you a greater tax deduction through depreciation if after 6 months, you no longer like to live in the property, you rent it out. Because new properties do depreciate more, but you can claim it as a tax loss. There's only one major downside. And this downside is major. In the high risk of valuation shortfall. I've seen horror stories whereby people will buy an apartment for 800,000, valuation comes at 600,000. The worst that I've seen was a property in Ashfield. The client bought a property, a two-bedder for 960,000 in Ashfield, and 2 years later, the valuation, all valuation that we've done with different banks, comes in at less than 700,000. So I'm not trying to scaremonger you, but be wary of valuation shortfall. Make sure you're getting value out from the off the plan, because it is a given. Off the plan properties has a price premium factored in by up to 20%. than a comparable 1 or 2 years property. And a lot of first-home buyers like the nice glossy pictures given by developers. Keep that in mind. It's nice and glossy and better than the A4 print that I give you because you're paying for it. Whereas my services is at no cost. Just keep that in mind. Be wary of valuation shortfall. So how can a mortgage broker help you? There's no charge at this point for our home loan services because there's more and more compliance standards going around. We're thinking of charging next year. We're still on a thinking stage, but at this point in time, no charge for our home loan services. Our brokers are paid the same rate of commissions, regardless of whether you get a loan from any bank, QDOS, ANZ, Westpac, Commonwealth Bank. We are paid the same. We have access of 30 or more lenders in the market. Having said that, to be fair, just keep that in mind. Westpac and Commonwealth Bank and their affiliates have about 50% of the home loan market, which is why I'm saying a lot of people think that it's a competitive market. I think it's dictated by the major banks. Just Commonwealth Bank and Westpac have close to 50% of the market. The top 4 lenders have about 80% of the market. And then the rest of the 400 lenders spread out, have the 20% share of the market. And we can help you make it easier by preparing the paperwork, loading the application, and doing all the follow-up work on your behalf. We can do up a face-to-face interview if you really want it, all right, because we may be sick. So we can do virtual meeting on the spot between 8 to 8 o'clock, including Saturdays. If you're buying a second-hand property, we can provide up to 5 free Residex and RP data reports for you. If you do it yourself, it costs something like $50 each one for each one. All our loan consultants are degree qualified, and if you need an in-house financial planner, we have one in place for you. So how can we help you compare and contrast different products? We help you simplify the loan process. We structure the home loan to your needs, and we inform you of special offer. You do have to keep that in mind. Lenders with special offers, you have to have a realistic expectation of the service delays. For example, right now, ANZ is offering $3,000. If you refinance a loan to them, St. George $4,000, even if you just refinance a $250,000 loan to them. The process, I tell my client up front, is going to take 3 months because you're just going to be at so far back at the queue. So realistic expectations have to be given for lenders with special offers because they're just inundated with applications. We can help you increase probability of finances. And if we think that we are not confident in getting you a loan, we will tell you outright. We're not going to string you along and tell you, oh, it's looking good. It's because just to drop our application could easily take us 6 hours. So we will tell you up front if we think that we are unable to help you, rather than to waste all stakeholders' time. Your choice. There's some lenders that accept high-density inner-city off-the-plan or studio apartments. Which are these lenders? You'll find that among the major 4 lenders, ANZ, they have no postcode restrictions most of the time. All right, they still have a number of apartments that they blacklist, but in general, 99% of the time, they don't have a postcode restriction, and they may lend up to 90 or 95% for it. 95% lend is a maybe, because technically, ANZ can only lend up to 95% for existing customers of ANZ. Some lenders will lend up to 80%. Some lenders will lend up to 70%. As I've just given you an idea, if you buy in Piermont, where my shop is located, since June this year, if you buy an apartment in Piermont, CBA will only lend up to 70% if you don't want to pay mortgage insurance, and 90% if you are willing to pay lender's mortgage insurance, not 95%. And a lot of lenders will not lend for studio apartments. Suncorp, for example, even if you just want to borrow $20,000 or $500,000 studio, the answer will be no, because it is a hard policy. They don't lend for studio apartments. Some lenders may waive lenders' mortgage insurance, especially if you are a professional, earning more than 150,000 in the legal and accounting field. If you're in the medical field, you're a doctor. Unfortunately, this doesn't apply to nurses. All the major 5 lenders plus HSBC can lend up to 90% without mortgage insurance for doctors because they are deemed as recession-proof. Some lenders may offer a discount on mortgage insurance. CUA right now has such an offer, a discount on mortgage insurance, and the same as a company called Heritage Bank. Some lenders, this is St. George at this point in time, can lend up to 85% without mortgage insurance, up to a $1 million loan. Most lenders will never waive their mortgage insurance charges. Some lenders may accept temporary residence applicants on probation or with minor credit defaults. Unfortunately, a lot of people do not know that they have a minor credit default, which is why it leads back to what I say in the beginning. Get yourself a credit report to know what the lenders is going to find out about you. And without that report, we don't know how to handle the situation for you as well. May consider the above when borrowing more than 80% of the property value. Many will not consider at all, regardless of your income, because you're deemed as not credit worthy. Lenders have varying lending ratio. You can see here, if you have to borrow more than 800,000 and you want to go on interest-only repayment, forget about Westpac and Suncorp, they won't lend. Newcastle Permanent could still lend up to 80%. So different lenders have different lending ratio threshold. Just because the lender says they can lend you 95% does not mean they're going to lend you 95%, especially when you borrow more than $1 million. In my mind, if a client comes to me like that, 95% lend, I want to buy a $2 million property, I think of 2 lenders, NAB and Commonwealth Bank. Makes life easy for me. So lenders have offer varying rates for the same product, and the rates could differ by more than 2% for the same product. Why? They go by mortgage size. The bigger the loan in general, the greater the discount. Lending ratio. For example, if you go to Macquarie Bank, there's a different rate at 60, 70, 80, 90, and more than 90%. Are you buying the property for owner-occupied or investment use? As an investment property, if you're, say, staying with your parents rent-free, if you treat the property for investment, you can actually borrow up to 8 times your salary. So I'm on 100,000, I may potentially be able to borrow 800,000. Why? Because estimated rental income in owning the investment property and tax benefit can be factored. And because I'm living rent-free, it increases my borrowing power substantially. The downside is, if you treat the property for investment, most lenders charge a premium of 0.55% for it over an owner-occupied property. Repayment time. If you're paying interest only, the risk to the lender is higher, and most lenders charge us 0.5% again premium over someone paying principal and interest, which explains why interest rate could differ by 2% between client number 1 and client number 2. This just gives you a guide. A person on 100,000, no dependents whatsoever, no credit cards, how much you can borrow. A person on 150,000, dependent child, and with $20,000 of credit card, how much you can borrow. It varies again between lenders and their appetite. And this is not definitive. It's affected also by living expenses. How much do you spend a month? So lenders have varying paperwork requirements. A lot of lenders, if you go to Commonwealth Bank, for example, they need your last month of transaction statements and credit card statements. You go to Suncorp, they need 3 months worth of it. You go to Macquarie Bank, they don't require any of the above. Why? Because online lenders and certain lenders at the forefront of technology like Macquarie Bank, I would say, they don't look at statements anymore. All they look at in approving or declining a loan is your credit report, which re-instill why I was saying that getting a copy of a credit report is important, which is why they can access the loan that quickly. I can tell you what are the difference, all right, in terms of time frame. I submitted a loan with Macquarie Bank last Friday. I got a formal unconditional approval yesterday, which means that it took them a day to fully approve a loan. I submitted an ANZ loan for refinance back in June. At this point in time, I'm still waiting for the loan to settle. It takes 4 months. So different lenders have different, that you must have a realistic expectation of different lenders, because at that time, back in June, ANZ was still offering $4,000 cash rebate, even if you just have a $250,000 loan. The different lenders that we have in the market. So using a mortgage choice broker may only take a couple of hours, inquiry meeting applications. And if you want to talk to us, best if we set up an virtual meeting. Why do I suggest this? So that everything that we talk about is logged, and then we send you a copy of a lending scenario straight away. But if you just talk to us on the phone, at the end of the day, just that I've confused you even more so now than before you attended this webinar. You just got to forget everything. Just my 2 cents here. Inquiry meeting applications, we are at no cost at this point in time. So this is the one on my last few slides. Showstoppers. What are the showstoppers where clients are not satisfied with us, or we are not satisfied with the clients that we are getting? What are the showstoppers? As I said, if you want to engage our services at no cost, we need a copy of your credit report. Without that, there's many things we cannot help you mitigate. A pre-approval does help you mitigate, let you know your borrowing power and also whether you have any credit defaults, but it does not mitigate valuation risk. Just because you got a pre-approval does not mean that you can go out to buy a property in Zetland at 95% land and the property is worth 1.3 million. Keep your financial statements at hand because you may need them. Ensure that you pay your credit card's bill on time and do not exceed the credit card limit. Because there's no point telling the bank, I forgot, I went on a holiday in Victoria and I can't come back and pay the bill. Probably the assessor have listened to that 20 times for that month, and they're not going to care, because whether you get a loan or not, it's not going to affect them. If you have varying names, your middle name is in your passport but not in your driver's license, or your driver's license and your birth certificate names differ, make sure you get a stack deck done beforehand. Lenders are very pedantic about this than 6 months ago or even 1 year ago. Like, for example, when I submit an NAB application, I'm actually more worried about getting the identification than whether the client will get a pre-approval or not. Because I know with 99% certainty, when I say they can get it, they will get it. But getting the identifications done is hard. And why is that the case? They will scrutinize every single document you give them. Because Westpac was fined last month $1.3 billion. I repeat, $1.3 billion for breaching anti-money laundering provisions, which is why the favor of the month by my overlords is identifying you. All right. And official statements with period ending on the 30th of June must be supplemented by interior online statements, which is also why, to help my clients mitigate this, we are now using an app called bankstatements.com.au, which will simplify the document collection process of savings account statements and mortgage statements to 1 minute. Please do tell us the truth. For example, I was doing a loan for a client, he's self-employed. Yep, everything was good. And I wasn't told that he was on JobKeeper. That makes a hell of a difference. Yep, if you're on JobKeeper, it's the lender may not lend you the money. So I only know that after I submitted the loans, and I was querying about his JobKeeper payment. So obviously, no one is happy. Lenders with special offer often have lengthy service delay. Choose your conveyancer and solicitors wisely. Don't just go for the cheapest guy in the market. Why? Because as a first-home buyer, you probably have a ton of questions. If you find someone that costs $800, I can guarantee you he just won't have the time to answer all of your questions. All right. So choose your conveyancer or solicitors wisely. Speak to your friends. Speak to or whether they are comfortable with their conveyancer or solicitors, and they can recommend one to you. Getting one pre-approval is healthy. Please do not go out there to get multiple pre-approvals. That will just kill off your credit score. Because with credit scoring, all that is being done is profiling. And someone with multiple credit inquiries tend to default more than people with just one inquiry. I repeat, getting a pre-approval is healthy, it's great. But don't get multiple pre-approvals. That will just kill off your credit scores, because multiple inquiry reduces your credit scores. So often as a first-time buyer, you will often hear this from a real estate agent. Someone with a higher offer than you. What are you going to do? Well, don't bother about asking. Just keep this in mind. The real estate agent don't work for you. He works for the vendor who pays him. So don't ask about whether this is true or not. You can reply to him on who made the offer. Have they even inspected the property? Do they know that this is a high density area where lenders have restrictions in lending? Have due diligence been conducted by your solicitors or building inspector? Do they even have finance in place? And why do they like the property so much as to pay $30,000 more than you? Are they asking for an extended period? What are you trying to achieve here? You're trying to create doubt. Because a lot of, especially if you buy an apartment, a lot of offers fall through because subsequently the first home buyer is unable to get finances. Create doubt on your rival's offer. When I told this to a client who was buying in Kansas yesterday, he actually lost the property today. All right, so everything that I say is subjective. But just keep that in mind. You often will be asked, so be told someone make a higher offer than you. What are you going to do about it? Do you want to counter offer? And you will never find out whether this is the truth or not. So to conclude, find out how much you can borrow. Choose the lender and loan that's right for you. Get a pre-approval, please. Before that, get a credit report. Decide on the property and finalize on it. You get formal unconditional approval. You sign the loan offer document immediately. Don't put it on top of the fridge. And finally, the property is yours. You just completed a major milestone in your life. And if you have any questions, this is me. We hold a webinar all the time. And the next one is not on the 25th of October. I wrote this wrongly tonight. I was dreaming it was actually 25th of November. So as a guide, we run this once every 6-7 weeks. So I thank you for your time. I'm sorry there's no question time. Just that I don't want anyone to fall asleep because this is a very, very long webinar. And I hope you have a good time watching Netflix or have a good dinner tonight. Thank you very much for your time.